It is natural to feel a little uneasy when it comes to planning your financial future. After all, if you're new to personal finance, investing, retirement savings, and everything else, then it can be daunting to know where to start. You don't want to make a huge mistake with your hard-earned money. Well, that is where a financial advisor comes in. But how do you find one, let alone one you can trust? What are the attributes of a good financial advisor? What sort of qualifications do they need to have? And what is the best way to work with a financial advisor to plan for your future? Hi, I'm Kim, and in this Finance Spark video, we're going to talk about how you can find a financial advisor, what to look for, and how to work with them to get the best results. Are you ready? Me too! Let's go! What does a financial advisor do? By just examining the name itself, you can find the answer to that query. A financial advisor is a person who counsels people on money-related choices. Financial advisors can assist you with a range of financial issues, such as assets management, tax obligation, stocks, funds, or other types of insurance. You might have heard of other professions with similar names, such as financial planners and wealth managers. These professions each have specific jobs in the industry. A financial planner is more focused on long-term planning and less on transactions, while a wealth manager works with high net worth individuals. While we can all agree that a financial expert is a valuable member of your team of professional advisors, before choosing the best advisor, he or she must meet all the right requirements. If you make a wrong decision, it can do more damage than good. Here are 3 core areas to address before entrusting any financial professional with your hard-earned money. They're known as the 3 C's: custody, conflict, and competence. Get these areas right, and you will likely have found yourself a great counselor. The first C is custody. In 2008, Bernie Madoff became a headline in the finance world. He was one of the best money managers in the country before his collapse. When customers gave money to Madoff, he would deposit it into his accounts. He would present financial documents showing incredible developments. If his customers asked for a withdrawal, he provided the funds without any difficulty. The money withdrawn was not their actual money. It was funding from new investors. Because he had control over their accounts, Madoff spent their money. He thought he could continue this scam as long as there was a constant flow of fresh assets. But when the markets crashed in 2008, investors were strapped for cash. They began to panic and demand withdrawal requests. There were too many withdrawal requests, and Madoff failed to accommodate everyone. What does this mean for you? You should engage with a financial advisor that has an established asset separation policy, also known as custody. Invest your funds at a respectable brokerage business that provides detailed statements, such as Vanguard, Fidelity, or Charles Schwab. If you want to authorize your advisor to do trades using your account, you can issue a limited power of attorney, but your advisor should never have access to your funds. It's like the saying goes, don't give your money to anyone if you don't want them to be able to take it quickly. Bernie Madoff even stated that third-party custodians should be required for advisors and brokerages. Independent custodians should be in charge of keeping customer funds. The second C to check in a financial advisor is conflict. Unfortunately, not all financial advisors recommend investment vehicles with a client's best interests in mind. They do not operate under the fiduciary standard, which is established by the Investment Advisors Act of 1940 and defines a registered investment advisor. According to a fiduciary standard, the client's best interests must come first. Wikipedia defines a fiduciary as a person who holds a legal or ethical relationship of trust with one or more other parties. Typically, a fiduciary prudently takes care of money or other assets for another person. A registered financial advisor acts as a fiduciary and is required to exercise the greatest degree of care. One of the differences between investment brokers and financial advisors is that brokers are not actually required to act in your best interests. I mean, they should, and most do, but some don't. And if your financial advisor also wears the hat of an investment broker, then they need to be sure to do each job properly. For financial advisors, any potential conflicts of interest must be disclosed, and advisors are not allowed to engage in transactions that benefit their personal and professional interests. There's also the suitability standard. This requires them to provide suggestions that fit their client's situation. Financial advisors are subject to the standard, but investment brokers are not, so they may make suggestions based on what will provide them with a bigger profit margin. These type of financial advisors are called dually registered advisors or dual hat advisors. They can work both as an independent investment advisor and as an investment broker. If they are in their financial advisor role, they must behave in your best interests. When they wear their broker hat, they are released from any such duties. So, how can you tell if this person has two roles? You can always look them up online. The company's name will be your first stop. Then, search the broker-dealer. If you see that, it implies they are properly registered, and if so, you'll probably see that a lot of the company's funds will wind up in your portfolio. You shouldn't be shocked if an advisor you deal with attempts to sell you their firm's funds. You have to question yourself about the finances of the corporation. Keep in mind that you want this individual to continue acting in your best interests or the best interests of your family, and not for his personal or professional gain. Next, I'm going to uncover probably the most important thing to look for in a financial advisor. But first, be sure to subscribe to Finance Spark, where we post videos every week to help you boost your financial mindset. Oh, and don't forget to smash the bell icon to get notified when we release a new video. The last C is competence. Finding a reliable and knowledgeable financial counselor is more than just picking a name. To find what's best for you, examine your advisor's qualifications. A Certified Financial Planner, or CFP, is the highest level of qualifications. A person who has earned a formal accreditation from the Certified Financial Planner Board of Standards is known as a Certified Financial Planner. CFPs assist people in a range of financial management topics, including retirement, investment, education, insurance, and taxes. Another distinct and accepted classification is the CPA profession. In terms of tax planning, this individual is an asset. Both of these titles call for extensive college coursework, a formal test, and ongoing study. Next, you should determine whether this financial advisor is best for you. The higher the net worth of the clientele they are working with, the better. You don't want someone learning their job while working for you. You wouldn't want to be your dentist's first patient, right? Don't be a part of someone's learning process just because they say they can do it. Make sure the advisor you're dealing with has a plan that you can support. Let them explain their plan. The expert you're working with must have feasible concepts and a methodical approach. Make sure this individual has been thoroughly vetted and is a good fit for you. Let's say that the recent market volatility has you worried. An advisor can assist in presenting a context that demonstrates how volatility and acceptable returns can coexist. Find an advisor who is able to competently explain the market, can share how to execute a successful plan, and is able to educate you in a non-patronizing manner. Communication is key. Lastly, the relationship you have with your financial advisor should also include some type of encouragement. According to studies, encouragement from an advisor has a favorable all-around effect, enhancing both behavior and returns. Even if you choose to work with a financial advisor, you should remain actively involved. This financial advisor should be there to help you, not to take your place. Remember to seek someone who can influence your behavior positively by teaching you, by promoting a good environment, and by motivating you to achieve success in all facets of your life. You might have heard horror stories about bad financial advisors taking advantage of unsuspecting clients. But now that you have a better understanding of how to find a trustworthy financial advisor to bring you to a more profitable and secure future, hopefully you will avoid those sorts of issues. Of course, be sure to do your research, due diligence, and educate yourself on money matters. And of course, that is where Finance Spark comes in. If you liked this video and want to learn more about how to spark your financial mindset, then be sure to subscribe, like, and get notified of our future videos. Thanks so much for watching, and I'll see you next time.